This is the Chapter 7 video recap dealing with all forms of partnerships, general partnerships, limited partnerships, and limited liability partnerships. Covers a lot of ground. I will do my best to try to knock this out in about 10 minutes or so. So let's get started with it. Okay, let's see. Let's talk about basic partnership concepts first. A definition of a partnership. This is very important. It's an association of two or more persons to carry on as co-owners of a business or profit. So right there, we see a distinction between that and a sole proprietorship that we covered in the previous chapter, chapter 36. Sole proprietorship has one person. Partnership has at least two people. The tax treatment of a partnership, it is a pass-through entity. So the money you make at the partnership passes through to the partners, and the partners are taxed on an individual level. The partnership itself is not taxed. And that would be, say, contrasted with corporations that have double taxation, which we'll talk about in another chapter. How is a partnership formed? Well, it's formed by a partnership agreement. They can be oral, written, or implied by the conduct of the parties. It's a good idea to get it in writing, especially if you're dealing with a partnership that deals with real estate. You're required to have that one in writing under the statute of frauds. Take a look at the text on page 706, and that gives you some good elements and provisions that are commonly in a partnership agreement. But the agreement will usually talk about the duration of the partnership, whether it's going to just go on indefinitely or for a certain period of time. It talks about what the partners' rights and duties are, their capital contributions, how the profits will be shared, which is an important thing. You see, let's say I contributed $40,000 to the partnership and you contribute $10,000 to the partnership, but we don't have a written agreement spelling out how the profits will be allocated. If there's no written agreement, when the profits are allocated, it'll be 50-50, even though I've contributed more to the partnership. So I'm going to want a written partnership agreement that says, I get, for every dollar you get of the profits, I get $4 based upon our ratio of the capital contribution. When it comes to rights of partnerships, they have rights to be able to have management of the partnership. In a general partnership, both parties have equal say in how it's run. Interest in the partnership is usually based upon your capital contribution. Each partner has a right to inspect the books and have an accounting given to them of how the partnership is coming along. When it comes to duties and liabilities of partners, partners have in general a duty of care and a duty of loyalty. The duty of care is like in torts, you have a duty of care not to do something terribly negligent, not to make stupid mistakes in your decisions in running the partnership, because it's not just about you, it's about your partner as well. And a duty of loyalty, you will not do anything that would be a conflict of interest to the partnership, not engage in self-dealing. So you have because you have a loyalty, a duty of loyalty to the partnership and the other partners. And then when it comes to liability, in general, the partners are personally liable for the debts of the partnership. So if the partnership goes under, and there's money owed, my personal assets as a partner in the partnership are at risk. My house, the bank account, cars, assets, and so forth. So it's important that I get some liability insurance covering that, or else my personal assets will be at risk. If we want to terminate the partnership, we might look to the agreement because it may say what acts would result in the termination of the partnership. Maybe it would terminate on a certain date or when a certain asset of the partnership is sold. A partnership might terminate when one or more of the partners dissociate from the partnership. And a partner has the power to dissociate, but not necessarily the right. So I can dissociate from the partnership, but you, as my partner, might be able to file a lawsuit against me for the damages that are incurred as a result of me pulling out of the partnership. Because as a result of that, we had to terminate the partnership, and you wanted to keep that partnership, that money machine going. So, in a situation like that, if I tried to just dissociate from the partnership, you may just try to buy me out. or bring in another partner to take my place so that you can keep that business going. If you do have a partnership that terminates, whether it's for the right purposes or the wrong purposes or whatever, the usual scenario in dissolution and winding up is to sell all the assets of the partnership, pay all the debts that are owed to all the creditors, and then whatever's left over, any remaining funds will be distributed to the partners per the partnership agreement. And that's something else we should acknowledge is that in the partnership, the assets of the partnership don't belong to the partners. It belongs to the partnership. The partners merely have an ownership interest in that partnership, not in the assets per se. Limited liability partnerships are usually ones that are formed by professional organizations like law firms or CPA firms. And they have the best of both worlds in that the money passes through to the various partners, but there is a certain amount of limited liability for those various partners in the LLP. So let's move on. The next type of partnership is a limited partnership, an LP, a little different from a general partnership in some respects. A limited partnership consists of at least one general partner and one or more limited partners. So you still have a minimum of two parties involved, but at least one general partner and one or more limited partnership. When the limited partnership is formed, they have to put together a certificate of limited partnership and file it with the state's Secretary of State's office to officially go on record of being a limited partnership. Limited partnership will talk about what type of business it is and who the agent for service of process is and where it's located and so forth. And in a situation like that, that way other people can know if they need to sue the partnership where they can serve the agent for service of process. Liability of partners in an LP. General partners, their personal assets are at risk. Again, their house, their cars, their assets. A limited partnership, as long as they remain a limited partnership and don't act like a general partner, as long as they remain a limited partner, their liabilities are limited to the extent of their investment in the partnership. They have a limited liability, hence the term limited partnership. But that's a two-sided coin. They don't engage in the day-to-day operations of the business. They're passive investors in the partnership, and so their liability is limited. If they act like a general partner, even though they're only a limited partner, if they act like a general partner in the day-to-day business, they could be held to be a general partner as opposed to a limited partner, and their personal assets may be at risk. Well, let's see. Rights and duties, same as a general partnership. Right to inspect the records, right to an accounting, the right to receive your profits as they pass through the partnership, and so forth. And the duties, duty of care and duty of loyalty, just like the regular partnership, as we previously discussed. How about dissociation and dissolution? Exactly the same as well. They have the power to dissociate, but not necessarily the right. If a general partner wants to back out and say, I'm out of here, that could be a problem because they could be wrongfully dissociating from the partnership, and the limited partners are going to say, well, wait a second, you got a good thing going here. So we either need to find a new general partner, or one of us needs to step up and become the general partner. We'll buy this guy out and keep this business going. In the meantime, we might have to file a lawsuit against this person for any damages that might incur as a result of that wrongful dissociation. When it comes to limited partners, they're passive investors. It's pretty easy to buy them out. They can come and go without much of a problem. Let's bring in a new limited partner. This one is going to leave. We'll pay them off and leave. For the purpose of dissolution, same thing. We sell all the assets of the partnership, the buildings, the inventory, everything, get all that money, pay off the creditors, and whatever's left goes to the partners per the partnership agreement. So there you have it. That's partnerships in general. I managed to cover it all in less than 10. Let me sign off now, and I'll see you at the next video recap. Bollinger out.